Picture this. You've spent years working hard, saving every spare gold coin you could find, until one day you finally have a chest full of treasure. Now comes the big question. What do you do with it? You could leave it buried on a deserted island, but over time, inflation quietly chips away at its buying power. The treasure is still there, but it doesn't buy as much as it used to. So instead, you decide to put your treasure to work. You load every last gold coin onto a single pirate ship and send it off across the ocean. At first, everything looks fine, but then a storm rolls in, or the ship strikes a reef, or pirates attack, or maybe the captain simply makes a series of terrible decisions. Whatever the reason, that one ship sinks. And with it goes every coin you worked so hard to earn. That's exactly what investing in a single stock can feel like. Now imagine a different approach. Instead of buying one ship, what if you owned a tiny piece of an entire armada? 500 ships, different captains, different cargo, different destinations. If one ship sinks, the other 499 are still sailing, still trading, and still bringing treasure safely back to port. That armada is an exchange-traded fund, or, more commonly, an ETF. And by the end of this video, you'll understand exactly what an ETF is, why millions of investors use them, and why they completely change the way many people invest. Let's start with the name, because it sounds far more complicated than it really is. ETF stands for Exchange Traded Fund. 3 words. Let's break them down. We'll start with the easiest one. A fund. Think of a fund as one giant treasure chest. Companies like Vanguard or iShares gather money from thousands, sometimes millions, of investors. Everyone contributes a little gold to the same chest. Once they've gathered this enormous pile of money, they use it to buy a huge basket of investments. Sometimes that basket contains hundreds of different companies, sometimes thousands. Instead of you having to buy every company yourself, the fund does it for you. Now let's look at exchange traded. Imagine that giant basket has already been built. The company takes ownership of the basket and slices it into millions of tiny equal pieces called shares. Those shares are then listed on the stock market, also known as the exchange. Because they're traded on an exchange, you can buy or sell those shares throughout the trading day, just like you would with an ordinary stock. And that's really the magic of an ETF. You aren't buying one company. You're buying one small slice of an enormous basket. Now here's where ETFs really begin to shine. Diversification. It sounds like one of those intimidating financial words people like to throw around. But the idea couldn't be simpler. Don't put all your treasure on one ship. Spread it across many. Diversification isn't just about protecting yourself when something goes wrong. It's also about making sure you don't miss the companies that end up doing incredibly well. Think about technology. Can anyone say with certainty which company will create the next revolutionary product? Probably not. You could spend months researching and still guess wrong. Or you could simply own the entire fleet. If one company becomes the next big success story, you're already on board. Let's see why that matters with some quick math. Imagine you invest $10,000 into one company, just one. Unfortunately, that company has a terrible year. Its stock falls by 50%. Your $10,000 instantly becomes $5,000. Half your treasure, gone. Now let's rewind. Instead of putting $10,000 into one company, you invest it into an ETF holding 100 different companies. Your money is spread evenly. About $100 goes into each company. One of those companies still crashes by 50%. Your $100 becomes $50. So you've lost $50 on that ship. Not great. But now, look at the rest of the fleet. The other 99 companies have a completely ordinary year. Nothing exciting. Together, they grow by just 1%. Your remaining $9,900 grows into $9,999. Now add back the $50 from the struggling company. Your total investment is now worth $10,049. Think about that for a second. One company inside your investment literally lost half its value, and you still made money overall. That's the mathematical power of diversification. No crystal ball required. Of course, no captain sails for free. Every ETF has someone managing it behind the scenes. They make sure it continues tracking whatever it's supposed to own. For doing that, they charge a small yearly fee called the expense ratio. Think of it as the captain's cut. Now here's something that surprises a lot of beginners. Tiny fees don't stay tiny forever. Because they're charged year after year after year, they slowly eat into your returns. Let's use another example. Suppose you invest $10,000. Then you leave it alone for 20 years. Let's also assume your investment earns an average annual return of 8%. First, imagine you're paying a 1.5% annual fee, which was common for many actively managed mutual funds. After 20 years, your investment grows to roughly $35,200. Now imagine everything stays exactly the same, except your yearly fee drops to around 0.1%, which is common for many broad market ETFs. Now your investment grows to roughly $45,700. That's about $10,500 extra dollars. Not because you picked better companies, not because you took bigger risks, simply because less money quietly disappeared into fees. That's why investors pay so much attention to expense ratios. Another nice feature of ETFs is dividends. Many companies share a portion of their profits with shareholders by paying cash dividends. Since an ETF owns hundreds of companies, it collects all of those dividend payments. It bundles them together and distributes them to investors, often every 3 months. So even though you only bought one ETF, you can still receive the benefits of owning many different dividend-paying companies all at once. Now, not every ETF is trying to accomplish the same mission. Different fleets are built for different voyages. Broad market ETFs are designed to follow an entire stock market index. One of the most famous tracks the S&P 500, which includes 500 of the largest publicly traded companies in the United States. Instead of trying to decide between Apple, Microsoft, Amazon, and hundreds of others, it simply owns them all. Sector ETFs narrow their focus. Maybe only healthcare companies, maybe only energy companies. Instead of a mixed fleet, you're sailing with ships that all specialize in the same trade. Dividend ETFs focus on companies with long histories of paying dividends. Commodity ETFs work differently. Rather than owning businesses, some hold physical assets. For example, actual gold stored securely in vaults. So how does an ETF compare to other ways of investing? Buying a single stock means owning one company. If that company succeeds, great. If it struggles, your investment struggles too. A traditional mutual fund also owns many companies and offers diversification. But unlike ETFs, traditional mutual funds are generally bought and sold only once each trading day after the market closes. ETFs trade throughout the day, just like regular stocks. Historically, they've also tended to come with much lower management fees than many traditional mutual funds. Now, before we look at a few real-world examples, a quick note. Captain Ledger isn't handing out financial advice today. We're simply reading the map. Always do your own research before making investment decisions. With that said, let's look at some of the biggest investment fleets sailing today. The Vanguard S&P 500 ETF, known by its ticker symbol VOO, tracks the 500 largest companies in the United States. It became the first ETF in history to surpass $1 trillion in assets under management while charging an incredibly low expense ratio of just 0.03%. Another giant is IVV from iShares. It tracks the very same index, manages hundreds of billions of dollars, and also charges around 0.03% per year. Then there's QQQ. Instead of following the S&P 500, it tracks 100 of the largest non-financial companies listed on the NASDAQ stock exchange. Because so many of those companies are technology leaders, QQQ is often associated with the tech sector. Again, these aren't recommendations. They're simply examples showing just how enormous ETFs have become. So let's weigh the good against the bad. On the plus side, you get instant diversification with one purchase. They're usually very inexpensive to own, and they're incredibly easy to buy and sell from almost anywhere. On the other hand, you don't control every company inside the basket. If one company in the index isn't your favorite, you'll still own a tiny piece of it. And if you buy a broad market ETF, don't expect it to consistently outperform the market. After all, it is the market. Its goal isn't to beat it. Its goal is to follow it. And for many investors, that's exactly the point. So the next time you're thinking about investing your hard-earned treasure, remember this. You don't have to bet everything on one ship. Sometimes the smartest captain isn't the one chasing the biggest prize. It's the one commanding the strongest fleet. That's the idea behind ETFs. Simple, diversified, low cost, and one of the most important investing innovations of the last few decades. If you found this guide helpful, be sure to subscribe to Captain Ledger Finance for more straightforward explanations that help you navigate the world of money with confidence. Until next time, may your winds stay fair, your compass stay true, and may your portfolio always find its way safely back to port.